Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to test and do things live and hope they work. So even though this is pre-recorded, I do it unedited just for fun. So we're going to talk about bonds, interest rates, and more bonds. There seems to be a lot of people that still think interest rates are going to 5 to 6%. That's not going to happen. I'm not saying it will never happen. It's just not going to happen in the short term. There's some reasons why I want to show you. Hopefully, everything will work. As we've had, it doesn't always do that. The content of this video provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as recognition or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity, opinions expressed in the video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So why don't I edit these? For fun. It's really challenging when you commit to this, push record, and say, I am not going to edit. Sometimes I have to because I make an inadvertent mistake, but it's just a lot more fun to do it unedited. Let's go and take a look at the NASDAQ McClellan Summation Index, showing liquidity moving up. It should be because the stock market is moving higher, but liquidity is still real weak. It's below zero. Has not got above zero, and I find it amusing that Ken Fisher has two of the same identical ads, and he keeps staring at me. I don't know why. But anyways, liquidity is trying to push higher, but is struggling here. It tells you that the internals of the market, something is not wrong, or something is wrong. Even though stock prices are moving higher, there's just not a lot of money pushing behind it. So you're seeing what is called margin expansion, where people are simply just buying stocks, regardless of what the news is. There isn't a lot of money sloshing around, and markets are trying to push higher. Of course, that is a natural direction of stocks, is to go higher. But from a liquidity standpoint, the market cannot absorb a lot of selling. So if there were a lot of sellers to hit the market, there'd be a problem. But in the meantime, we know liquidity remains weak, and if this thing does not get back above zero, at some point we are going to see a big purging of stock prices. All right, well, let's get Ken out of the way there and move on to the issue at hand. So, as I've mentioned, people think interest rates are going up. People do not understand the monetary system. They've never studied it. It's not taught in high schools. It's marginally mentioned. Maybe paragraph or two in a four-year degree. It's not until you get into a master's or really into a doctorate program where you're really going to learn about it. And by that point, you're going to learn a very specific view of it, typically what's called Keynesian monetary policy. So you're not actually going to get a wide range of theory of Keynesian, Austrian, and who knows whatever the other smaller theories are. But nevertheless, people just think that nobody's going to buy U.S. government debt, even though we have long histories of showing that as government debt goes higher, interest rates go, there we go, lower. See, unedited, never know. I gotta look at the screen and see where this is going. But despite the facts, people still think otherwise. Okay, so let's go back now and look at a relationship that really should tell us the answer is when interest rates go lower. And you'll hear this. People will comment, well, Steve, interest rates are low again. Isn't that really good for the economy? Yeah, well, it's only really good if people go out and buy homes and cars, computers, and finance a bunch of stuff. That's the true tell. Because let's just say interest rates were zero, and I went down to the car dealership and stood there all day and not a customer walked in the lot, interest rates aren't the issue. There are other problems in the economy. Same with housing. If no one buys as interest rates go lower, it's not interest rates. Or you could argue that they're still too high, even if they're very, very low. Well, fortunately, we can actually figure that out. So this is a chart of real estate loans at all commercial banks on a year-over-year basis against 30-year fixed-rate mortgages as shown as a percentage. So fixed-rate mortgages on average are around 3.5%, which is pretty darn close to their all-time historic lows. Now, the last time they were this low was you see 2013 and then 2016 they were sitting here. But what happened to real estate loans on a year-over-year basis? They increased. So you can see as interest rates went down, people bought. So in that case, so in 2013 and 2016, interest rates were a problem, and we needed lower interest rates to continue to get people to buy homes. Okay? But that doesn't always work that way. So right now, you see interest rates are back near their all-time lows, and look at what's happening to real estate loans. They're flatlining. Yeah, they're still growing at, it's not going to show, is it? Somewhere we'll just extrapolate to an 8 or 9% growth rate year over year, but you can see it's declining and rapidly slowing down. So lower interest rates aren't going to help. Now, if interest rates were going down, and let's say this thing was just shooting higher, like right here back, say in 2003, yeah, then you could say, well, obviously the Fed needs higher interest rates to slow down inflation. But you can look at this and say, no, interest rates aren't the problem. So what is the problem? Well, the Fed pumped asset prices up through quantitative easing and zero interest rate policy. And even as asset prices are high, interest rates aren't actually low enough to get people to buy. Or you could also take the fact is, over the last 10 years, everybody that wanted to buy a bunch of stuff did. And those that wanted to take advantage of low interest rates did. And now they're tapped out. So the notion that interest rates are going to go up from here is not visible in data, because if interest rates were, let's just magically make interest rates 5 to 6%. If the housing market, is already, you see the loans declining, well, what is that going to tell you? If interest rates go up, this thing's going to go down. You don't see too many relationships. You see a couple of them where interest rates went up, but that's after mortgage loans were taking off. But generally, when interest rates go up, the number of mortgage loans goes down. So there just isn't any case for higher interest rates here. There's no demand. I mean, that's really what it comes down to as well. If there was a huge demand for homes and cars and other things that are big ticket items that people finance, yeah, you see higher interest rates. But the fact that you have 30-year loans at 3.5% on average, and you're not seeing booming demand for housing, tells you there's a problem. Now, in the Friday update, and it was one of the things I just couldn't wait, I wanted to share. This is something we've talked about before. It's hardly anybody. I mean, you'd be really hard pressed to find anyone talking about world dollar liquidity. And those that do don't make a lot of mention of it. It's more of an offhanded comment in their writings. But what it is, the federal debt held by foreign and international investors plus the St. Louis adjusted monetary base. Now, we know the St. Louis adjusted monetary base has everything to do with the Fed. When the Fed raises interest rates and unwinds their balance sheet, they cause the monetary base to fall. And when they ease, they cause it to rise. And then federal debt is held by foreign investors or international investors. It's just as simple as people buying or selling U.S. government debt. Now, of course, you've heard that nobody wants to own U.S. government debt. It's hardly true. So if we look at this relationship where we add these two together, we get world dollar liquidity. Everyone right now thinks the tariffs are causing the problem in the economy, and it's not. If the tariffs went away tomorrow, yeah, it would help, but it's not going to have a major change. Sure, maybe people buy some stocks, markets may rally a bit, but it's not going to change the overall dynamic because the Fed removed dollars from the global economy, which are needed to conduct trade. Essentially, the tariffs were just a double whammy. But now what you'll notice is world dollar liquidity on a year-over-year basis is slowly starting to rise. Now the question is why? Well, let's go and split these two apart. See if we can get them on. Shoot. I don't know if we can do something. Let's try this. Didn't think so. So you can see, we'll first look at federal debt held by foreign and international investors rising, which we've looked at. So we know that foreigners are buying U.S. government debt. They have to. Now let's go back and see if we can get B on here. Let's see what's going on with. Is it going to work? Aha, There, St. Louis adjusted monetary base. Slight increase, almost nothing. So what is going on here, let's put this back because this is relevant, is in order to get us out of this global economic slump, foreigners have to buy U.S. Treasury bonds. They have to take the dollars that they have, that they need for trade, and push it back to the United States government, who's got to run through the bureaucracy, however long that takes. It takes a long time. And then gets funneled back out into the U.S. economy, into consumers' pockets. And then they have to in turn buy stuff, foreign goods, to get the money back overseas. And then the system can start to get restarted. That's what's going on here. It just takes a lot of time. Do you think these foreign governments, foreign central banks want to do this? Of course not. Now let's go in and see, what does this mean for interest rates? Well, we can go and add 10-year Treasury yields. And we'll switch them. This is, like I said, this is a fun part of doing things live, as we'll see. So what's happening? The general relationship here is when world dollar liquidity rises. Now think, why is it rising? Or why will it rise? Two reasons. One, foreign central banks and investors buying U.S. Treasury bonds. Remember, buy bonds. Buy bonds, what do interest rates do? Go down. Number two is the Fed has to ease. What happens when the Fed eases, whether they lower interest rates or engage in quantitative easing? How do they do it? They buy bonds, cause interest rates to go down, okay? Keep that in mind. So when you look at this chart, and you can see going into the last recession, world dollar liquidity shot up and interest rates went down. So the fact that world dollar liquidity is rising is a really good sign. In fact, if we zoom in here, you can see that interest rates peaked kind of right at the point where foreign investors started buying U.S. Treasury bonds. Isn't that amazing? So everyone says, oh, they're going to dump their stuff. No, they have no choice. If they want to resurrect the global economy, they must buy U.S. Treasury securities. Must. Now, that's pretty cool. We'll maybe spend some more time on that on Friday. Let's overlay the volatility index. This, when I did this, kind of blew my mind. I mean, it was like, whoa, this just tells you what happens when foreign central banks and the Fed starts to ease. Look at what happens to volatility. It shoots straight up. Isn't that crazy? That volatility and world dollar liquidity, boom, rise at the same time, except here in the early 2000s where we got the tech bubble blew. But look at that. You see them moving together, and it makes a lot of sense. Why? Because when easing happens and foreign central banks buy U.S. Treasury securities, what happens to liquidity in the market? It goes away. Volatility spikes. People pile into bonds because volatility is rising, and boom, you get a recession. Pretty crazy. So all the people that are saying interest rates can't go higher, they are going to higher. They're wrong. They have to go lower, because in order to get us out of this global slump, to keep it from a recession, which is going to happen anyways, you've got to have people buying bonds to put liquidity back in the market. Why do you think these foreign investors and foreign central banks are practically screaming at the Fed, ease? They say, look, you took away the liquidity. You pulled all these dollars out of the economy, and this is all we got left. And the only way to fix this is we have to put more of ours back and finance your massive deficits? Yeah. That's exactly what you have to do. Let's hit some charts real quick. Look in the S&P 500. It's got a chance to now make a run at the all-time highs, hit 3,000 today. Why do I say that? Because look at the volatility ETF, which you will never buy, sell, trade, short, buy options against, long, short, do anything, derivatives of, nothing. You can see it's kind of sitting right in the middle of these two zones. Support is down here, which tells us around July 18th and July 18th right in here. So it tells us that there's a shot that this could either get a little higher or it's going to hang out here, but volatility is stretched. This thing is probably not going to get a whole lot lower without attracting people to buy. And why will big players buy this? To hedge their stock positions. Let's take a look at the bond market. 10-year treasuries are backing up to their 50-day moving average. Again, this is awesome. I don't know if they're going to get all the way up to their 50-day. Tells me they're probably going to go sideways until the 50-day curls down. We'll see. That's where we'll rebalance the portfolios and pick up the long bonds because they're holding resistance really nicely today at 2.2. The 50-day moving average, which has just been bulletproof. Again, remember, rallies begin, and of course, rally and treasuries are reversed here. So cross the 50-day and then confirm the 50-day. This is pretty cool that we're seeing this play out. So I like that a lot. And the last thing we'll look at is oil and gas producers, which is kind of surprising. You get a couple of weeks in a row of crude oil draws. And what did they do? They were rejected right at the top end of resistance. So they were resisted yesterday and today, which tells you the market, or at least the big players, even though the market wants crude oil higher, the big players say crude oil is lower. And of course, the answer is, why did the stock market go higher? The answer is because yields are moving up. Wait till yields run into their roadblock, and that party's over. All right, so I'm Steve Van Metre. Hope you enjoyed today's update. Again, now you see the bond bull market has just begun. This thing is not over yet. When foreign investors keep buying, banks are buying bonds, Feds will be buying bonds. When they start cutting it more, world all liquidity goes up, volatility goes up, and bond prices go up. I couldn't chart bond prices because they don't have that available on the system. I'll see you Friday. Bye now.